What is happening with your personal allowance and what do you need to know? Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. In our most recent budget, the Labour Party confirmed that our personal allowance of £12,570 will be remaining the same for the next about 5 years. Now, we might look at this and go, oh, that's good news, they've not reduced it. However, it's also bad news because they haven't increased it. What this in reality means is that over the next 5 years, as hopefully our income increases, whether that be from our rents, from salaries, from dividends, we are going to be starting to see more tax being paid. Because ultimately, we're still only getting the same £12,570 tax-free, and that is not increasing. In addition to this, the fact that it's not changing, we also need to be aware that we've got some increasing tax rates kicking in. So even if your income stays exactly the same, you are not going to be in the same net tax position. Now, if your income is limited, then unfortunately, I'm the bearer of bad news here to say that your disposable income is actually going to be reducing. Because if you have a salary of around 50,000 and some of that is rental income, the tax rate on rental income will be going up to 22% from 20% in 2027, which means you'll be paying an extra 2% of tax on your rental income. In addition to this, from April 2026, the dividend tax rate is going up from 8.75% to 10.75%, which, as you can tell, again, is only a 2% increase, but obviously this all adds up, that it's little bits being pulled from different places. This means if you're on employment, this is not a problem. Your personal allowance will stay the same as your salary hopefully increases over the next however many years. You'll have more income, you'll pay more tax, but hopefully your disposable income won't be too badly affected. If you are someone who has potentially a salary and rents, then actually you'll be paying more tax on those rents. For those that may be getting their income from maybe a salary because they have their own company, maybe some dividend income from their property company or a trading company, and their income from a rental property, with keeping things exactly the same, you will actually have less disposable income. So this therefore means you may need to be paying yourself more dividends, more income, to take into consideration if you're taking the same amount of income that you're getting, your disposable income will be reducing, which therefore means that you may need to have more income, which means your income will be higher and your tax bill will be higher. So there may be a bit of a calculation, a bit of tax planning you need to do to kind of go, if you need 45,000 and all of a sudden your tax bill is now an extra 1,000, you actually need an extra 1,000 of income plus the tax that you'll pay on that income to get exactly the same amount of disposable income. Obviously, the reality is that you may need at least the same amount of income, disposable income. You may actually need more disposable income because obviously all the costs are going up. I know from my experience with children maybe in swimming classes or dance classes or different activities, as well as your own personal sporting endeavours or interests, whether that be music, sports or any other type of activity, all the costs of doing these things are also going up. So the reality is your disposable income will need to be increasing. So with tax rates increasing and your disposable income needing to increase, you may need to be having a look and doing a bit of tax planning to see, well, what do you actually need as disposable income? What is your mortgage? What are your council tax, your bills, family costs, personal costs for activities, entertainment, and all these things to get an idea of, well, what do you need? Now, if you are in a salaried job, this becomes a little more limited because you don't have flexibility with your income. If you have rental properties, if you have your own companies, whether that be rental property or trading business, you need to kind of be assessing, well, what is that generating? How much money can I be taking to see whether that will be sufficient for your expected monthly costs. Other considerations you may need to make on top of that is obviously with certain things like child benefit or tax-free childcare and any other benefits or other income you're getting, you may just need to assess what impact it has on that. With child benefit, you start to lose it when you hit 60,000 income, and you lose it entirely at 80,000. For tax-free childcare and those sorts of services, they kick in at 100,000. So depending on your income and where things are coming from, you may need to balance out, if you are in a position to, with rents, with dividends, to manage that side of things, because you don't want to suddenly have an extra 1,000 of income and then you find you lose other things. So there is a bit of a look at how the picture is looking, see how it fits together, and potentially do a bit of a forecast of, this is what I'm expecting, this is how much my tax is going to be as we move into these increased tax years, to check that you're going to be able to afford the tax payments which come every 6 months, and also that you have sufficient income, which is going to give you the life that you want to be living, which obviously anyone I speak to who is in property is all about doing it to achieve some sort of goal. This goal may be getting out of the day job, it may be spending more time with your family, it may be going on holiday more often. There's always something that is a driving factor of why people are doing different things. So you want to make sure that even with some of these tax changes, with how things are fitting together, you are able to be achieving those goals. Otherwise, as I always say to people, what's the point of all the hard work? This is not an easy process, as anyone who is invested in property will have found. There is always a bit of work, you have hiccups, you have problem tenants, you have problem houses, things go slower than you want them to go. So all of these things happen, so you really have to be focused on what you're trying to achieve out of it, and if it's not achieving that, then go back to the drawing boards or go back to the thinking process and go, how do I actually get it back on track with what I'm trying to achieve? Because there's no point working really hard to not get what you're trying to get to at the end of the day. So our personal allowance is staying the same. Is it good news? Is it bad news? I would probably say it's bad news, because it's not helping us with the increase in inflation and the fact that the cost of money is going up all the time. However, this is what we're working with, so this is what we need to be focused on to try and maximise our income, to minimise the tax we're paying, and manage this process over the next few years as we see what happens in the wider world around us. Hopefully today you've got an idea of what the impact of your personal allowance staying the same is going to have on your tax liabilities. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel. And let's make tax less taxing. Let's make tax less taxing.